good afternoon and welcome. You're watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon.
Pankaj, Nifty is back to sub 18,300 levels with profit booking witnessed across the board post Fed meeting outcome. Once again, we have fear of recession, which is haunting the markets globally. How are you approaching the markets at current level?
So, well, you are right that post FOMC meeting, we are seeing global volatility on the rise, and as a result of that, in our markets are down this particular week. And Nifty has sort of given most of the gains, and what we are seeing is that technology, again, as a sector, is being laggard. And along with that, we are seeing even banking losing some sheen because we have seen banking as a segment sort of doing quite well for the past 1.5 months.
True.
But broader markets, especially small caps, have done relatively better. I think global
Mhm.
markets are expected to remain under pressure because if Fed is still sort of sounding hawkish in terms of guiding for a terminal rate of 5.1%,
Mhm.
and with the kind of retail data which is sort of coming out, our sense is that the US economy could sort of slow down more than anticipated, which is what is sort of triggering recession globally, and that is having a sort of impact globally also, and as a result of that in our markets. I think
Okay.
so that way, global volatility is still going to remain there. But having said that, we haven't seen the volatility spiking up too much. The yields in US are also sort of haven't really sort of spiked up, and largely
Mhm.
triggering from the fear that you will see more of a rather than inflation fear. Now we have recession fear, which is sort of gripping the market.
True.
And with that in perspective, the challenge will always be with the export sensitive sectors, be it ITU, be it some of the other names. So I think those segments are going to remain under pressure. And obviously that will have implications. But domestically, our sense is that things are not really bad because our inflation print is far more lower than what RBI has even guided for this particular quarter. So that way, I think our domestic economy is largely sort of insulated from that perspective. And the way we have sort of outperformed global markets, our sense is that that trend is probably going to continue for some more time, even in the coming days as well.
Pankaj, we all know recession is not good for any of the economies, but one thing which can be good for India is the falling crude oil prices. We have government of India also acting, and we have seen cuts in the windfall tax that was, put on these oil companies. So, what is your view on the oil and gas space as such?
So yes, I think we've seen triggers like say $60 cap being put on Russian crude. Then obviously US is sort of hiking rates, so that is triggering recession fears. And
Mhm.
the Chinese front also things are not so good with an elevated level of concern on the COVID still, despite the fact that they are opening, things are still not sort of looking that calm. So
Mhm.
obviously it has implications for us in terms of lower inflation, and one of the biggest beneficiaries of this has been the oil and gas sector. Now, when you sort of
Mhm.
look at oil and gas sector, there are some things which have sort of are panning out. One is the losses on the diesel side has sort of reduced from say 15 rupees a liter in the month of October to about 2 rupees a liter, and now our
Yes.
sense is that they are about to sort of break even.
Mhm.
Petrol has been sort of profitable, so our sense is that that will be somewhere about 8 to 9 odd rupees. And
Mhm.
on a blended basis, I think our sense is that the OMCs could be probably incurring a loss of, or could incur a loss of about 2 3 rupees in Q3. But one of the side effects of decline in crude oil is that you will see inventory losses for a quarter.
True.
So Q3 could see inventory losses. So
Mhm.
that way, I think with Singapore GRM sort of normalizing and marketing side companies are not expected to make loss. I think things are recouping, or there is a sort of a turnaround in the fortunes for some of the OMCs.
Mhm.
But that could sort of trigger a more of a what do you call a technical upside rather than sort of a structural portfolio plays, because we've
Okay.
seen crude related volatility sort of keep on hampering markets, and
Right.
specifically this segment. Nothing changes for the upstream companies because their realizations are capped at about $75 per barrel, so nothing
Mhm.
changes for them. But it's a good relief for the downstream companies.
Mhm. Pankaj, but rightly as I said that it is really for the downstream companies, but kind of intervention that we have from the government for this oil space as such, would it be prudent to say that stay away from investing in these companies for long term?
Long term would be difficult, but for short to medium, for medium term, yes, because one is, I think what you're sort of seeing is that the overall industry is shifting towards EV. So, which is why all these downstream companies need to sort of tilt more towards the petrochemical side, which is where the expectation that you will have a reasonable demand growth. But I
Absolutely.
think the challenges always lie in terms of what kind of margins they are able to make, because government
Mhm.
also has to sort of look at multiple fronts, be it inflation, because when you sort of look at, despite the volatility in crude oil prices, the retail petroleum product prices have been sort of stable. So and as a
Right.
result, OMCs were making losses. So, which
Mhm.
is why it's very difficult to take a portfolio level call for these downstream companies or upstream companies. But
Mhm.
yes, short term there is a relief.
And we have elections coming up in 2024, and that might also put some pressure on the oil marketing companies to not increase the prices if the crude prices go up. So that is the kind of intervention that spoils the game for oil marketing companies. Let's now move on to the sector which did quite well this week, Pankaj, that is sugar space. I mean, there are news going around that the export limit might be hiked by the government. So, what is your take on this space and your favorite pick for medium to long term?
So sugar as a space, there are a number of triggers. One is the crushing season is sort of going on. So our sense is that probably you'll have better production this year because of the better recovery rates. Because last year that got impacted a bit.
Mhm.
Obviously that is there. Then I think the government has already sort of given 6 million tons of export. There is an expectation that for the 3-4 million tons might get exported if the government takes a call in the month of January.
Right.
And our sense is that overall, when you sort of look at from a blending perspective, about 4.5 million ton is used for blending, which is at
Mhm.
10% level. So even
Mhm.
if the blending is going up to say 12%, I think you have ample sugar available for diversion. And so either export market or either ethanol, I think both are sort of quite remunerative for sugar companies. So I think both
Mhm.
ways they are sort of placed well. And since you will have higher recovery rate, so your cost of production this year is going to be lower. So that way, I
Mhm.
think overall sugar as a space is looking attractive. Already we have
Mhm.
seen structurally their multiples have moved from mid single digits to high single to low double digits. And if
Right.
ethanol sort of keeps contributing higher, which is a lesser volatile business, then our sense is that companies in this space will continue to sort of benefit.
Mhm.
What we sort of like is something like Triveni Engineering or Dalmia Bharat Sugar. So I think these are some of the names which have been positive on, and some of these names are in our recommended portfolios as well.
Let's talk about Reliance Consumer, which has formally launched the FMCG business venture and with the announcement of brand independence. How do you see this really impacting the already established FMCG players in the food business? Do you see some kind of impact or disruption won't be there?
So, sort of when you look at food as a business is one segment where the opportunity lies. I mean, which is what one space we have been liking, be it Tata Consumer, be it ITC, or a number of other players. Now, we all know that the distributors have been sort of complaining of lesser margins given by FMCG companies. Now, with a
Mhm.
Reliance entry into broad categories, say right from staples to say beverages to processed food or other daily essentials, I think what it is going to probably do is that it might offer higher discounts and will try to sort of push their products. Now,
Mhm.
historically, we have not seen major sort of change in terms of new entrant sort of gaining market share in a shorter span of time. But
Mhm.
what it can do is that it can sort of cap their margins structurally going forward, because somewhere down the line they'll also have to offer higher discounts. And
Right.
that is where probably the challenge would lie, that structurally, since all these companies trade at rich multiples, probably multiples might get capped, or we might see a sort of a lowering of or contraction of these multiples over a period of time. But having said
Okay.
that, nothing happens in a very short span of time in FMCG, so it's a sort of a long walk before any of these kinds sort of thing pan out. But yes, one needs to be watchful given the fact that Reliance has big pockets. So obviously, it's a sort of a tough competition now in the food as a overall space within FMCG.
ITC stock is down nearly 4% in last two trading sessions. Is it a buy at dip, Pankaj, if somebody wants to really accumulate?
So ITC, I think, could benefit from two, three factors. One, obviously, the other associated business like hotels and all. So it's a sort of a good season. H2 is typically good. Now, the other positive can be that if there is a stable taxation, nothing comes adverse in the budget. So that is another positive. I think what the government is also thinking on the lines is putting higher taxation on gutka and other forms of tobacco, which is
Right.
more harmful for people. So if that happens, probably that can sort of trigger a shift from these loose way of consuming tobacco to a better way of consuming in terms of cigarettes. So that can be sort of a structural positive from the near to medium term. So which is why we are positive on ITs as a overall space with a target price of 405.
Okay. Let's now talk about the PSU banks. They have been in momentum, a little bit of profit booking at higher levels. So, what are you doing there?
So PSU banks, when you sort of look at, we've seen 50-60% kind of a move in a lot of these stocks. And what we have seen is that obviously when you look at growth, the growth has come in double digits. The return ratios are improving. So PSU banks are set for a further re-rating. And we have seen that historically, bigger PSU banks like say, SBI, Bank of Baroda, or Canara Bank, I mean, they trade somewhere about zero point 0.8 to 1 time book. But in their peak cycle, they have traded at about 1.2 to 1.5. And that is when in 2014 types. So obviously there is a scope for further re-rating, which can happen. And same is the case with mid caps and small cap players. So they might have been trading in the range of say zero point 0.4 to zero point 0.7 odd percent. That can go to 1 time book. But our sense is that since we have seen a huge rally of say 50, 60 odd percent and markets are sort of consolidating, so probably profit taking can happen and that might sort of trigger say 15, 20% kind of a cut from current levels. So I think
Okay.
one should not be really chasing this because we have already seen a good chunk of move. Probably once the correction sort of happens, then I think the names like SBI, say Bob, Canara Bank or Indian Bank, I think some of these names is what we like. So I think that is what people can look at from a buying perspective, but not at current levels given the steep run up what we have already seen.
Pankaj, when we talk about the housing space, we all know that it's a very interest sensitive space because when the interest rate go higher, there is some substantial fall in the demand. But there's a lately CRISIL report which says that home price in India are set to rise by 6 to 10% this fiscal and 3 to 5% next fiscal. Looking at the picture that we are seeing currently with no demand fallout as of now, do you expect the ancillary business, ancillary housing ancillary companies like your pipes, like your wires to do better?
Absolutely. I think what we have seen is that when you look at plastic piping companies, I mean, for them, key raw material is PVC prices. So one point of time it benefited when the crude oil and the associated declined. But after that, we have seen a sharp run up. And from there again, we have seen a cool off on these. As a result of this, there has been a lot more volatility in margins, and which is why if you look at last quarter, companies had suffered inventory losses. Their EBITDA margins declined by 500 to 600 bips. And our sense is that from H2 onwards, things will sort of normalize. So now expectation is that they'll deliver normal growth, normal margins. So you'll see a recovery of say 400 to 700 bips for companies like Supreme Industry and Astral. And demand side, our sense is that overall agri demand or housing demand is going to be good. And from that
Okay.
perspective, all these companies are senses that can deliver 16, 17% kind of a growth. And which is why we like this space, especially companies like Supreme Industries or Astral, where our target prices are about 2850 and 2380 respectively.
What do you
And
like in the real estate space and the wires space?
now, on the wired space, again, 70% of the cost is obviously copper, and copper also has been volatile in the last, and that has created fair amount of volatility because companies had to pass it on, and then since it's a price sensitive segment, the demand gets impacted, and companies also get impacted. One, because the dealer does not sort of stock inventory, then you have higher sort of cost of inventory sitting, and that leads to inventory losses. So,
Mm-hmm.
which is why a lot of these players have, especially players like Havels or Polycab, they have been impacted. Our sense is
Okay.
that overall prices are not sort of stabilizing. We'll see lower
Mm-hmm.
inventory losses going forward. We'll expect margin recover by 100 to 120 odd bips. And
Mm-hmm.
overall, our sense is that with government capex in the revival mode, plus fresh inventory sort of building up, we would
Mm-hmm.
expect a decent mid-teen kind of a growth in these companies. And
Okay.
overall, our sense is that next 2 3 years, these companies should do well. And what we like again is something like Havels and Polycab here. Now,
Mm-hmm.
coming to real estate. Now, real estate, one, yes, the prices have been inching up, and there are reasons for it because when you sort of look at last or this particular cycle, RBI has hiked rate by about 2.25%. Now, general
Right.
expectation is that it will lead to lower demand. But what we are seeing is that when you look at top 7 cities, the sales are at lifetime high. Then overall, the inventory, what you see is at a 7 or 8 year low of
Mm-hmm.
21 odd months. Largely because the demand is so good. When you sort of look at the last 2 years, the IT professionals have got a good hike. In general, the hikes have been better. Then I think there is a demand for bigger houses. So a lot of these factors are sort of driving the demand, and which is why we feel that since our inflation trajectory is sort of easing a bit, so this is one
Mm-hmm.
space which has not been performing, but our sense is that now it should sort of catch. And which is why we like Bangalore heavy players like say Brigade Enterprises or Mahindra Life space. And Phoenix is a sort of good mix in terms of this is one company which is the biggest mall operator. So overall premiumization of consumption is what is captured through real estate in this company. So I think these are topics in this space. Price-wise,
Mm-hmm.
we don't expect real estate prices to correct because if inventory is sort of coming down and if input cost prices are expected to sort of move up, then I
Mm-hmm.
think pricing is something which is not expected to come down. And industry is getting far more organized. I mean, now you see top developers contributing 25% of the overall sales compared to this was single
True.
digit few years back. So that
True.
way, I think the dynamics in real estate is sort of changing for better.
Bharti Airtel as a counter is holding on very well, consolidating at current levels. While Reliance is also doing good, but Reliance is a diversified company with the, you know, 3 to 4 verticals playing out for them. So, what is your view on the telecom space with 5G rollout now, looking much more ready to hit the markets in 2023?
Absolutely. So I think 5G is around the corner. I think one obvious implication is that typically when you look at data consumption per user is somewhere about 21 to 22 odd GBs per month. And with 5G coming in, there is an expectation that it will jump to about 50 GB. So more than, and obviously that has the implication because voice is typically free. So that's a sort of a big leg up for all or both these telecom companies. I think what
Mhm.
is really not talked so much is the enterprise segment. Now, enterprise segment is somewhere about 85,000 crore kind of an opportunity. And here you have basically two segments. One is the sort of a normal connectivity, which involves voice and data connectivity, national long distance kind of a connectivity. And then you
Mhm.
have the other upcoming segment like IoT or cloud. So this is where our sense is that you will see bulk of the growth sort of panning out. So it
Mhm.
is possible that we might see an additional opportunity of about 1.4 lakh crores over the next 6 7 years on the enterprise segment, and that can be a sort of a big booster for both of these companies, especially Bharti Airtel and Reliance, given the fact that Voda is still sort of struggling to sort of raise money. So I think it's a sort of an interesting opportunity which will sort of which is going to be tapped by these two companies, and which is why I think both the companies structurally look positive from that perspective. I think price hike is still sort of yet not countered by the market, but our sense is that somewhere down the line, even the price hikes also will come into play. So obviously that could provide further levers to the overall growth opportunity for both these two companies. But it's an interesting opportunity shaping up.
Pankaj, have you already planned your holidays or you are still planning?
Actually, I'm going on a holiday next week. So and
Okay.
I mean, when you look
And
at
I want to ask, are your hotel bookings done?
it's done. So I think India is getting costlier. So we have already seen the ARRs being higher by 30%. Even the
Yeah.
I think some of the other destinations are not so cheap. But yes, I think hotel is one space where the supply is going to sort of increase by 3-4 odd percent, and our sense is that you'll continue to see more of ARR and occupancy to sort of driven growth. And then you have a couple of good events lined up for this entire sector. I mean, when you look at, say, for example, you have ICC World Cup, you have G20 presidency, which India is sort of holding in various cities. So obviously that will provide a good amount of leg up. So this is one industry which is coming in a good upcycle and is expected to remain in an upcycle for next few years. On the international tourist arrivals, if you look at our sense is that this year it is going to cross 2 crores. I mean, the last 2 years they have been impacted a lot, and
Right.
that is going to benefit most of your tier one names. So what we typically like is Indian hotels and lemon tree.
I didn't get my bookings done and I'm not finding bookings anywhere. So that's why I asked you the question and you gave me the entire explanation of what to buy in the hotel sector,
Well,
which
you'll
is
have
really good.
limited. Well,
Yeah.
you'll have limited choices, but to sort of take those rates because I think companies are very conscious of their strategy of keeping the rates higher and not really
True.
sort of chasing occupancy at any room rates.
So if I'm not going for a holiday, let me buy a stock then.
Absolutely.
So let's now talk about the hidden gem. So which is the company that you're going to talk about today?
So the company going to talk about is Bharat Forge. It's a fairly large company with a market cap of 41,000 crores. Here our target price is 1,050. Now there are a couple of reasons why we like this stock. So obviously a lot of business is well known, but one of the things is that the defense as a overall pie is only 5%. I think the company has been sort of making good progress there. So they have indigenously developed armored vehicles. Artillery guns is something successfully tested, and our sense is that company can capture a good amount of pie because the opportunity size is quite large, both domestically and even from export perspective. I think the other opportunity for this company shaping up well is that the international business is 70-75%. Now, in forging, also what you're seeing is that auto companies are looking at lightweighting of products and especially using products like aluminum. This company is looking to have or capture a good amount of incremental pie of this particular segment going forward. And which is why I think these are the two main reasons why we like this. And then company also has come up with a 2030 vision plan where they are talking about 12 to 15% CAGR kind of a growth with 20% margins, ROAS of 25%, 30% dividend payouts. So I think this company is sort of well set up for the kind of emerging changes which is happening in the auto as a overall space, and
Okay.
which is why we like this company with a target price of 1,050.
So hidden gem for this week is Bharat Fort with a target of 1,050. So major events are over, Pankaj. Your RBI policy is gone, your Fed policy is gone. Now we have Christmas season beginning, so we'll have volumes dropping down. So what is the strategy that you're playing with for the next week?
So yes, you're right that we don't have major data prints. I think the only major data print would be housing. So again, like Fed has sort of highlighted that they would watch out for more data to sort of see how the economy sort of slowing down. But having said that, our sense is that recent weakness is triggered by weak global cues, and our sense is that in the second half of December, usually the flows are better, and which is why we believe that probably Nifty can in this next week consolidation probably can come down to say 17,900 to 18,200, and from there and again we see a broader move happening. So all your FI favorite stocks, including banking, I think can do well. So we would expect heavyweights to sort of do well, but probably consolidation can happen till that time. So that way, our sense is that overall recent weakness in the market is should be bought into rather than sort of being scared of.
Thank you, Pankaj, for your time. It was pleasure speaking with you as always. Thank you so much.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.